Alrighty. So in today's video, we're going to be talking about when to short the market, because as we know, the market goes up, the market goes down. So when there's the opportunity for us to short the market, we want to know exactly when to do so and what kind of strategies we want to employ when we want to go short the market, right? So if you were to take a look at the market, right, let's just take a look at this chart. You want to ask yourself, where are you going to short the market, right? If it was you, right? Now, in hindsight, of course, it's going to be so easy for us to say, all right, this is where we want to go short, all right? This is where we want to go short. Another place we want to go short, another place we want to go short down here. And all these times you will definitely make money because you already know the market is going down. But what if you are faced with the current market condition right now? Let's say, for example, this is where the market is right now. Are you going to short the market? And if so, what kind of strategies will you use, right? What kind of option strategies will you use? So the question now becomes is, when is the best time to go short, right? So first of all, what you need to understand is that for the market in the long term, the market generally wants to go up, right? So that is why the index ETFs, the broad-based market, you can see the prices are getting higher and higher over time, right? So that is what you call the positive drift. The market wants to go up. But in the short term, the market is actually pretty random, right? You have what you call the random walk theory. So in the short term, there's actually a 50% chance of the market going up or down in the short term, and there's no one that can really predict where the market will go in the next 1 month, 3 months, 6 months, right? In the long term, in the next 10, 20 years, we know it's going to go up. But if we're going to do trading, we don't want to trade for the next 10 years, right? I mean, we have our investment portfolio. But what if the market presents itself an opportunity for us to go short? We need to be able to identify it. So the question is, how do we identify the short-term short opportunities, and how do you want to put these odds in our favor, right? How do we increase the chances that when we take a short trade, the market will actually go down? So there are two conditions to look out for, right? So the very first condition is when the market is overbought, right? So for this, you use what you call oscillators, right? Indicator oscillators such as the RSI and the stochastic oscillator. So basically, these are indicators that just tell us the current market condition, right? So basically, there is the overbought condition and there is the oversold condition when it's below the line down here. Now, of course, first of all, what you need to understand is that these indicators are just indication. It's not telling you that it's guaranteed that if the market is overbought, the market is going to go down, or if it's oversold, it's going to go up. We're all playing with probability here, right? So there's always still a chance whereby the market, when it's overbought, it can continue to be overbought and the market continues to go up, or when it's oversold, the market can still continue to be even more oversold and go down. So again, it's all probability, and we want to just increase it slightly above 50% so that we have the edge, so that in the long term, we're going to have a positive expectancy. So the first condition that I like to look out for is when the market is overbought. All right. The second condition is to wait until the market is near a resistance area. So a resistance area is basically the place where you see that the price have some struggles going above, right? So you can see that there are a few times where the market have, just kind of bounced off this kind of a ceiling, and then it went back down. So this indicates to us, that there is some kind of a force down there, a selling pressure, right? That whenever the price gets to that point, there's a lot of sell orders that makes the market wants to go down. So these are indications where there are resistance areas. So it's basically just previous high. So again, as you can see down here, what basically I do is you just draw one line across, and then the next time when the market reaches this area, right, there is a higher chance that the price could just bounce off this ceiling and then go back down. So remember, when we are going short, we want to find things that are in our favor, right? Where we can see that there are certain evidence that the market could be going down. So in this case, we just need these two conditions: when the market is overbought and when the market is near a resistance area. So when you put these two together, you actually have a pretty high probabilistic way of finding out whether the market can go down or not. All right. So again, it's not guaranteed. You're going to win some, you're going to lose some, but overall, you're going to have a positive expectancy trade in the long run. So now that you've identified that the market seems to be, probably going to turn to go down, the next question is, what are the best option strategies to use to go short? Right, so there are two different ways that you can go short about this. So first of all, is the simplest way is if you already own 100 shares of the stock, right? So let's say, for example, you own 100 shares of Amazon. Right, the simplest way would be to just sell a covered call. I've created many videos of this. You can go ahead to my channel and then click any of these covered call videos. So as you can see down here, if you already have 100 shares, and then given that, right, your price which you bought is below this price down here, below $160, so you can apply a covered call in a sense whereby you could either get out of it for a profit, or you could just use it as a way to generate some income. So let's say, for example, you can sell a covered call, and if it breaches your covered call, you can keep rolling up and out, up and out. Again, I've created videos on this. Go ahead to my channel and go and watch that. Alright, so the simplest way, again, is to sell covered call if you have already 100 shares. So as you can see, all the conditions are present. So the first condition is where the market is overbought, right? The stochastics is already showing that it's above this line, so it's overbought and it's approaching this resistance. So what you would do is you would consider selling a covered call above this resistance level. So you know that the market kind of have a little bit of difficulty before it goes back down, right? So this is a good place for you to sell the covered call. Now, if you want to be a little bit more aggressive, you could sell it at 165. If you're a little bit more conservative, you could probably sell, you know, a bit higher, 175 or above. Okay, so as you can see, the moment the market goes up, and as you can see, it did breach our previous resistance level, but then as it goes a little bit higher, you can see the market is severely overbought. That's where the market start to come back down. And the other thing is that if you were to sell a covered call, right, and you want to ensure that, you know, you do not get called away, rather you want to hold the stock for the long term, what you could do is that if the price actually, you know, goes past your covered call, it breaches it, you could actually roll up and out, as I mentioned earlier. So this way you can keep collecting more premium. And eventually, if the market goes down again, this covered call can expire out of the money. So you collected the money while you hold on to your stock for the long term. Now, the other alternative, instead of selling a covered call, you may want to sell a covered call ratio spread. Right? I also covered this in a previous video. It's called the enhanced covered call. You can go ahead and click the link at the top right hand corner of this video. But basically, the enhanced, or rather the covered call ratio spread, is where you sell two calls here and one call option below that. So what this essentially is actually a bull call spread. You have a debit spread from this point to this point, and then you sell one covered call down here. So you just only have one additional short call at $170. So what this does is that when the price goes up here, you can choose to sell away your debit spread for a profit, and then you can roll this additional call up here before the market goes down, and then this covered call will expire out of the money, and then you collect the income for that. So again, these are a few ways that you can kind of just, you know, change how you do your trade, right? You can have your covered call, just simply just short one call. You can have a covered call ratio spread, which is a covered call, using that income, or rather the premium which you receive from the covered call, to finance a bull call spread. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so what if you do not have any shares, right? Let's say you are just trading it, you do not have any long-term shares investment, you have a small account, right? So in this case, what you want to do, the easiest, the simplest way to implement the option strategy would be vertical spreads, right? So you have your credit spread, you have your debit spread. So in this case, let's start off with the debit spread, the credit spread, sorry, which is called the bear call spread. So again, you can see, first of all, what you want to look out for is for the two conditions to be present. Again, the market is overbought. You can see there's a resistance level down here. So what you want to do is, with a bear call spread, is you want to sell the short call above where the resistance area is, right? So in this case, you can sell one call option, right, at 460, and then buy back another call. This is to hedge your maximum loss. So this way, the loss will be the maximum of the width minus off the credit which you receive. So if you receive, let's say, $4 for this spread, and it's a $10 wide, that means your maximum loss will be $6, which is $600 per spread, right? So in this case, you can see that for the credit spread, we place the short call always above the resistance area. If you're a little bit more conservative, you may want to place the short call at 470 and then the long call at 480. So in this case, even though if the market does go up, let's say if the market does go up to 470 and then it expires there, right, at expiration, you at least still get the full credit for this credit spread. Okay, so that's the beauty about the credit spread. You can still be wrong in your direction. That means the market could still go up. In fact, it could still go up before coming down. You still would be able to make the full premium as long as it expires out of the money below this short call option at expiration. Right, so as you can see, the market did bounce off our short call, as you can see, because of the resistance area and it's overbought. It held off this point and then the market went back down. Now the alternative would be the bear put spread. So this is a debit spread. So instead of using the call option, you use the put option. So the difference between a debit spread and a credit spread is that the debit spread tends to have a lower probability of profit, right? With the credit spread, you notice that the market actually, right, let's say from this point on, the market still have some room to go, all right, before it comes back down, as long as below this point. So you have a small little margin of error from 450 to 460, where the market can actually just expire there at expiration. The market can be there at expiration, you still get the full credit. But whereas for a debit spread, it's a different case, right? It's slightly lesser than 50%, or sometimes you can even make 50% in terms of the probability of profit, right? The difference is that with a debit spread, you at least have a better risk to reward. That means you can get either a 1:1 risk to reward, or sometimes you could even get 1:1.5 or 1:1:2, right? So that's how you have a trade-off between the debit spread and the credit spread. Now with the credit spread, you can actually have a preemptive trade. That means you can actually take on the trade or place the trade once the market, has reached somewhere this point, right? It doesn't have to go all the way to 460, right? At this point, you can already initiate the trade. So in case if from this point the market goes down, you will receive the full credit, all right? Let me just remove all this drawing. So if the market goes down from here, imagine it doesn't go up here, you would still receive the credit. Now for the debit spread, you actually want to wait for the market to go a little bit higher first before you implement the debit spread. So that's how I would like to do it. I want to wait for the price to actually hit the resistance level first, then I actually enter the bear put spread, whereby the long put option will be at the resistance area. So in this case, if I want the market, let's say for example, I want to do the debit spread where it's 460 to 450, I need to wait for the market to actually go to 460 first before I implement the debit spread. Otherwise, you wouldn't have the right kind of price that you want, right? The cheaper it is if the market actually goes at the money or slightly out of the money. Then this way you will have a better risk to reward. So you have a better risk to reward, but the trade-off is, again, you may not actually get into this trade if the market from this point went back down. All right, so this is where you want to decide, which is better for you. If you prefer a better risk to reward ratio but a lower probability of profit, you can go with the debit spread. But if you prefer, a higher probability of profit, then you can go with the credit spread. Alright, so now let's go back to the chart which I first showed you at the beginning of this video. And now that we already know the two conditions that we're going to look out for, we are going to have a much better information for us to decide, whether are we going to place a short position or not, right? Are we going to place a short trade or not? So as you can see, we have the stochastics is actually showing that it is just crossing the overbought region, which means condition 1 is fulfilled. Now condition 2 is where there is a resistance area down here. So as you can see, we have approached the resistance area, and there's another resistance area at a 200 point and a mini one somewhere around down here, which is around $196. So at this point, the question is, are you going to take a short trade or not? So for me, when I take a look at this, I do think there is some chance that the market could go down, but then I would prefer to see if the market is a little bit more extended. As you can see, the market did, move down here before it went back up. So this could trigger to me, like it could be a new wave up before going back down, going back up again. So if I were to take this trade, if I want to, I would probably want to take a credit spread where I would choose a resistance area at this point and then place a credit spread above here around 195. right? For me, I would prefer to wait until the $200 level down here, which I feel this is a stronger resistance area since it has not been tested yet. As you can see, this has been tested quite a few times. You can see it tested once, tested twice, now I tested the third time. So whenever a resistance area or a support area has been tested a few times, it shows that the market may actually want to break through it. So in this case, I may just take a punt, maybe to put a credit spread somewhere at 195 and then to 205, so I have a $10 wide spread. So in this case, right, there is another resistance area that I'm playing with, but I'll just put a small position here. What I'm really waiting for instead is I would really want to wait for the market to go up here first, and then I will start to place a credit spread probably above around 205. So this way it gives me a better I feel there's a higher probability for the market to at least take a breather to come back down, and I'll be able to take some profits of this credit spread first. But again, at the end of the day, this is all probability. It doesn't mean that you're going to win all trades, but you're going to win enough trades so that your expectancy will be positive in the long run. Alright guys, so I hope you really enjoyed this video and it's been helpful to you, and if it has, I appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.